The average retirement age seems to have increased in recent years, and there are a number of reasons why. Perhaps the baby boomers have maxed out on hedonism and need to keep on working to support their habit. Perhaps the recognition of a longer life expectancy is keeping people in the workforce for longer because they feel they need more money for retirement, or perhaps they're just not ready for retirement. But at least part of it is due to the global financial crisis that ate into retirement savings and caused many people to continue working for longer than they may have planned to. If an increased retirement age is being established, then that process creates a retirement shadow for a period. There are about 125,000 64-year-olds in Australia and about the same number of 63-year-olds and 62-year-olds and so on. At some point, that's the number you'd expect to be retiring each year rather than the 30 to 50,000 that have been retiring in recent years. And then there's the backlog of people who put off retirement due to the financial crisis, and they'll retire as soon as they can. Over the next few years, we anticipate an avalanche of retirees, and the financial services industry will benefit. The nature of retirement has changed considerably over the past 40 years. To start with, the life expectancy of retirees has more than quadrupled. In the 1970s, people generally didn't have a lot of retirement savings because they weren't going to need much. Those who had money and had some application may have taken advice from stockbrokers, but most people just kept their money in the bank. During the 1980s, the financial planning industry started to emerge. It started as a cottage industry and stayed that way for quite some time. Over the past decade, however, much of the cottage industry has been taken over by corporate players, and the banks are now major participants. They've now honed their offerings to provide an integrated array of services to retirees on which they can levy fees. Generally in Australia, profit growth may be difficult over the next few years, and this will also apply to the traditional businesses of the banks. But they should garner significant profit from their wealth management businesses, and this should help drive up their earnings per share. The current share price of the banks is quite reasonable, and at these prices the anticipated yield is close to 7% fully franked, and if you allow for the franking credits, this is the same as earning 10% before tax. The last 5 years have also been tough for fund managers. They're paid on the basis of the amount of money that they manage, and poor investment markets substantially reduced their revenue and their profit. Improving investment markets and the avalanche of retirees should help their share prices to recover.